why most founders don't actually understand their numbers and why it matters. So, have you started a business? If so, let me ask you something. If I was to ask you, what is your gross margin? What did it cost to acquire your last 10 customers? How many months of cash runway do you have left? Could you answer those questions confidently? If not, well, you're not alone. The truth is that most business owners are exceptional at what they do. They build great products or value propositions, they win lots of customers, and they have remarkable resilience. But when it comes to understanding the numbers, there's usually a gap, and that gap is quietly costing them in bad decisions, missed opportunities, and in some cases, the business itself. I'm the fourth accountant, and today we're going to be talking about common issues founders face when they do not understand their numbers, why it matters, and what you can do about it. So, why do many founders fail to understand their numbers? And to be clear, this is anecdotal observation rather than criticism. We all have our strengths and weaknesses, and this is the clue regarding one of the main reasons. Founders are brilliant at building and developing value propositions to address a lucrative gap in the market. However, financial management is not normally what founders are passionate about, and it can often be treated as a distraction. And in the early days, that is fine. The numbers are simple enough that you can just keep them in your head. But as the business grows, so does financial complexity, and the gap between what you know and what you need to know quietly and quickly widens. As the gap widens, founders often understand they ought to know what is going on, but instead of actually asking the questions, there is a temptation to avoid the subject altogether as the business continues to seemingly successfully grow. And that avoidance is where the real damage can start. First-time business owners can often confuse profit with cash. For example, a business owner may think that because they have made a profit, the business is financially healthy. However, if a customer invoice gets paid later and later, a profitable business can quickly find itself without enough cash to pay its suppliers, employees, or tax authorities. Such a situation would mean the business would very quickly fail despite the profitability. The issue is that profit is an accounting concept intended to inform medium or long-term decision making, but cash on hand is what keeps the light on, and profit does not measure available cash. Essentially, you can still be profitable and go bust, and that happens more than you think. Conversely, however, founders may overly rely on bank statements, which intuitively makes sense. Cash is the lifeblood of any business. It's visible, it's real, it updates every day, and it feels like information. But in isolation, bank balances provide very limited information about your business. For example, bank balances will not tell you about any VAT liabilities quietly building up, any overdue invoices, stock you've already committed to pay for, or loan repayments that are due in the following months. A healthy bank balance may mask a deeply unhealthy business because it only provides a snapshot of cash in your business bank account, not the amount of cash actually available to reinvest in your business. Conversely, a low bank balance without financial insight can cause founders to panic when actually the business continues to perform well because cash is being tied up in the right places. Without context, a bank balance is just a number. It tells you almost nothing about the health of your business. Many new founders may just be unaware of which unit economics are relevant to their business and how to measure them. For example, at the outset of this video, I posed the question, do you know what it costs to acquire your last 10 customers? This cost is often referred to as cost of acquisition, or CAC, which includes the cost of sales and marketing activity incurred to win a new customer. CAC is often compared to lifetime value, or LTV, which is essentially the amount of fees you expect to receive from a customer over the full course of their business relationship with you. Ideally, LTV should be greater than CAC, and comparing the two will indicate whether or not your business model actually works at scale. As a founder, it is important you understand the relevant unit economics to your business and the industry and how to measure them. Instinctive feel and guesstimates will not suffice. The price of not knowing is what may inadvertently lose you more and more money with every customer you take on. And in such a scenario, your business may grow, but somehow doing business just feels harder. Now, this might be slightly controversial coming from me, but your accounting software, or rather its limitations, may actually be part of the problem. Platforms such as Xero and QuickBooks and Free Agent are excellent tools for new startups and are very user-friendly. However, founders still need an accountant to get the most value out of these tools. Platforms such as Xero, for example, will allow you to quickly run reports, get a P&L, reconcile your back statements, etc., etc. But no context will be provided. So it becomes very difficult for new founders to understand what financial data matters, what data is normal, and what, if anything, they should be concerned about. Data without interpretation isn't insight. It just feels like avoidable noise. And when something feels avoidable, well, we just tend to avoid that and focus on the things we can just progress with. Accounting software on its own does not provide any context or interpretation, and therefore cannot provide any meaningful insight to the untrained eye. Scaling a business is stressful, but it feels necessary to ensure potential sales opportunities and market share isn't lost. In the early stages, speed feels like the only strategy. There are products to build, customers to close, and problems to solve every single day. Sitting down to review monthly management accounts just feels like admin. It feels like something you can do when the business is bigger and more stable. But ironically, the businesses that need financial oversight are the ones that are growing the fastest, because the consequences of those bad decisions, or any bad decisions, will compound just as quickly as the business is scaling. By the time founders slow down enough to properly look at the numbers, they're already dealing with the fallout of decisions that were made without them. Ideally, financial clarity and oversight should be embedded from the outset in order to scale with confidence. Why does any of this matter? Well, as I alluded to, it matters because the success of your business matters. Every significant business decision has a financial dimension, whether it's obvious or not. This may be hiring a new salesperson, launching a new product line, offering a discount to win a new client, moving to a bigger office. All of these have cost implications, margin implications, and cash flow implications that play out over months and sometimes years. Founders who do not understand their numbers will make these decisions based on instinct and optimism. And if they're very experienced, this could actually work. But the businesses that scale successfully, consistently, and sustainably and outcompete their competitors are almost always led by people that have learned to combine that instinct with financial evidence. Gut feel can get you started, but financial insight is probably going to be the thing that gives you the financial edge. Cash flow problems are one of the leading causes of small business failure. Not bad products, not lack of demand, not competition, and as I say, not even profitability, but cash flow. A business can be growing quickly, winning customers, generating strong revenue, and still collapse because the timing of money coming in doesn't match the timing of money going out. Understanding your cash conversion cycle, your runway, and your burn rate isn't a financial exercise, it's actually a survival skill. And founders who understand the importance of cash flow and how it differs from accounting measures such as profit are normally best placed to navigate difficult periods that every business, and I mean every business, will face at some point. Financial problems almost never appear suddenly. They build gradually, leaving clear footprints in the numbers for months before they actually become a crisis. Gross margins are slowly compressing, the debtor ledger is quietly continuing to age, overheads are creeping up in percentage of revenue, and revenues are growing but concentrating in fewer and fewer clients. All of these are visible in the numbers, but only if somebody's actually looking for it and understands what those numbers and metrics mean. By the time the founder feels like something is wrong, the issue may no longer be straightforward to fix, if at all. If you ever plan to raise investment or borrow money to grow, your financials will be scrutinized, but more importantly, you will be scrutinized. Investors don't just back businesses, they back founders. And founders that can't speak clearly or confidently about their margins, their burn rates, or their revenue models, and the pathway to profitability will send a clear signal that the business is being run on hope rather than financial understanding. It doesn't matter how strong the product is actually. As you may have seen from programs such as Dragon's Den, experienced investors and lenders may lose confidence in founders cannot show they understand the numbers or that their growth model is financially sustainable. This lack of confidence can cost founders deals they otherwise should have won. To be clear, founders themselves don't actually have to have deep financial knowledge. However, investors would expect founders to address this skills gap, if it exists, by establishing financial oversight and expertise within top management. Corporation tax, VAT, PAYE, national insurance, etc., etc. These obligations accumulate in the background whether you're paying attention to them or not. And because they're not always visible in the day-to-day, they can build to a point where the bill, when it does arrive, is genuinely shocking. HMRC is one of the few creditors who can move very, very quickly when debts go unpaid. The interest, the penalties, the letters, the pressure, it can destabilize an otherwise very healthy business very quickly. Proper financial oversight means the obligations are planned for, and these things should never really be a surprise. And finally, not understanding your numbers limits how fast you can actually scale. Growth requires investment in people, in systems, in marketing, but investment requires that confidence. Confidence that you know your margins well enough to price correctly at scale, that you understand your cash position well enough to commit to new costs, and that you can model what the business will look like in 6 months or 12 months time under different scenarios. Founders who do not have that financial foundation tend to scale reactively without that confidence. They hire when they feel busy, they cut when they feel scared, and they're never quite sure if they're building something that is sustainable or if they're just running faster on the same never-ending treadmill. Financial clarity is what gives that confidence to turn ambition into an actual deliverable plan. So, if you are somebody thinking about starting a business or you're a founder facing these challenges that I've outlined, please feel free to let me know your thoughts in the comments and the descriptions, and reach out to myself using the contact details in my channel description, and also feel free to like and subscribe if you so wish. But in summary, not understanding the numbers isn't a criticism. Founders are not trained financial professionals. What is important is that the potential impact of this knowledge gap is understood, and that as a founder, you find a way to address that gap to give you the best chance of achieving your business ambitions. If you're concerned about the financial health of your business, or you simply just want to have a better understanding of the numbers so you can make better decisions more confidently, please also feel free to reach out for an initial financial health check, or just a general conversation about where your business is, what the numbers are telling you, and what you should actually be paying attention to. Otherwise, I hope you found that useful, but until next time, peace.